What's going on, guys? My name is Matt. This is Run Up the Score, and it is March, which means it's time for my 5 stock ideas for March. So usually what I do is over the course of a month, I'll probably do like in-depth research on maybe 5 to 10 companies total. And for the company to even get to the point where I'm doing somewhat in-depth research on it, it's got to be hitting certain parameters and like a pretty good idea to begin with. So I'm going to be sharing with you 5 that I've been going through the last month in this video. And it doesn't mean I'm buying these right now. I actually haven't bought any of these companies thus far. And the way I do things is I usually will only buy like maybe a few companies per year. So when I'm making these videos, it doesn't mean I'm buying them ASAP and that you should do the same. You should do your own research, of course, just to like generate ideas. And if you like the companies that I pick out, maybe it'll just generate some ideas for you. So if you remember last month, I went over 5 companies. There was Boohoo, Universal Music Group, Boston Omaha Corporation, Redfin, and Stone Co. So those were the 5. And since the time of that recording, I have purchased one of them. I've purchased UMG, Universal Music Group. At some point, I might do like a portfolio review, but you can see, I think when I discussed it, when I discussed it, it was right here. So it was about $22 and it dropped to the high 18 euro range. So I scooped some up because I know I followed Bill Ackman. He purchased his shares at $18.24 euro. 18 euro, 24 cents. I don't know, euro cents, I think they call it. And it's rebounded a little bit. So I'm still looking to add more, but I have half of my position filled in Universal Music Group, looking to double it though, to make it a full core position. But the way I do things is usually there's sort of 2 ways. The best way I've had the best results with is where I research based on how good the business is. So if the business seems to be really good, I'll do a pretty thorough analysis and see if I think it is indeed a good business. And then I will put it on a watch list and wait for an opportunity to buy it. The other way I find ideas is the price is really good. And then I go and I try to see if it is indeed a good business. Good business first is probably the better strategy, but one that is on the list today is going to be Facebook, which has dropped a lot and it's gotten into more of an interesting range. So that's one example of where the company's pretty cheap now. So I'm going in and I'm looking at the business prospects of what I think, and sometimes I get ideas like that. So let's get into the top 5 for this month. I like to go in reverse order of the one I'm least interested in to the most interested. So at number 5, we have PROG Holdings. A little bit of a boring business, but it's PRG as the ticker symbol. I've been following this one for about a year. And the story with this one is they are a recent spinoff about a year ago from Aaron's. If you don't know what Aaron's is, it is also publicly traded. AAN is the ticker symbol. And they are similar to Rent-A-Center, which is basically a lease-to-own electronics and like furniture store. So you go into the store. If you see like a $2,000 TV, you can take it home and you do monthly payments or bi-weekly payments. And basically, it's for like low-income individuals usually that have low credit scores. They want the $2,000 TV. They pay for it in monthly installments. And by the time you're done paying for the $2,000 TV, it ends up being like $3,000, $4,000. It's expensive. So that is sort of what Aaron's does. About 2011, I think it was, they bought Progressive Leasing, which is now PROG Holdings. And it's a digital asset-light version of Aaron's business model, but you could go into actual brick and mortar retail stores. In this particular area, Detroit area, you could go into Lowe's, Golden Fantasy Inc. I don't know what that is. K Jewelers, Zales, Diamond Store. So a lot of jewelers, a lot of electronic stores, mattresses, and you can go into the store. You can, if you say you go into Best Buy, you buy a TV, you go to the register and you check out with Progressive Leasing. So Progressive pays for the item, the individual takes it home, and then they are on a payment plan to Progressive Leasing. So if the item, once again, if the item costs like $1,000, you'll probably end up paying $1,500 to $2,000 over the course of like 6 to 9 months. That's the business model. Obviously, it relies heavily on the performance of their credit portfolio. So like how the people they're lending to, if they start not paying, which in down markets, obviously when the economy starts suffering, their customers don't pay as much. So that obviously is something to factor in. Little bit of history here. So you can see PRG, the ticker symbol PRG, it has a really long trading history. So this is the trading history of Aaron's. They did a weird thing where PRG spun off from Aaron's but Aaron's is actually the new trading, has the new trading history. So Aaron's is the old legacy business, brick and mortar retailer. PRG is the asset light version, but they have the old trading history of Aaron's, just so you know. So as you can see recently, I was following it back here at the time of the spinoff, which was, I think, right around here. And it has since dropped significantly, and it is becoming interesting. So if we look at it in QuickFS, which is my favorite tool for quickly analyzing things, you can see it's about a $2 billion enterprise value. And this is what's sort of attractive to me here. Look at these valuation ratios. 6.7 price to earnings. The acquirer's multiple 6.2. So you are paying 6.2 times the company's earnings before interest and tax to own the business. So if the earnings are durable and you don't think they're going to drop off significantly in the future, great purchase price, right? The thing to look for, and I'm finding this a lot lately when I'm seeing a lot of businesses that are really low price to earnings ratios. But if you look at the earnings, you'll see that 2021, because of all the stimulus, is a really good earnings year. That's not the case as much with PRG, although it is a little bit the case, because you can see their earnings typically have fallen at about the $2 mark. It's growing, and then they have some down years. So it's a little up and down, but I would say 2021 is definitely a really good earnings year. So to say that they're going to keep that up in the future is maybe a little bit questionable. And I think their guidance for 2022 is $3.30. The thing to consider with them, I would say, is like the terminal value of the business, what's going to happen over time. So there's a lot of new entrants into the space, a lot more like high flying, like Silicon Valley startup type companies that are competing with PRG. It seems like they have a pretty good customer base and like people trust them. They've been using them for years. So I'm going to continue monitoring it, do a little more research, but I'm definitely interested in the company at this point. At number 4, we have Meta, which is not, it's definitely outside of my wheelhouse. Usually I completely ignore big cap companies. So if it's over like maybe $20 billion, I'm not super interested, because my whole theory is like the bigger the company is, the more coverage there is, the more people are handicapping it. So you're just competing against more people. So I think there's just better fishing in lower market cap companies. So for that reason, I usually don't really look too much at companies like this. Obviously, we all know what Facebook is about. If you're not familiar, their stock price fell off a cliff lately. You can see huge gap down here. So it's about halved over the past 5 months. And it is now $204. It's about a $550 billion market cap. I also think they have cash on the balance sheet, which they do. They have about $40 billion in cash. So it's a $500 billion company. And you're getting really good earnings. But the thing to look at here is I would say Facebook is probably over-earning a little bit in the last year or two. Because before COVID, they were sort of slowly trending upward, like $5, $7, $6. So they doubled their earnings in the last 2 years. So how sustainable is that? I would have to look at what their guidance is for the next year. But you're getting an incredible company for a really cheap price. It seems too good to be true. And usually when that's the case, it is too good to be true and it's a little bit of a value trap. The major things with Facebook is they're investing heavily in the metaverse, which seems a lot of people are interpreting it as they're burning money. This is money you could be returning to shareholders. And if they said we're canceling the metaverse stuff and we're returning all of the CapEx that we would have been putting into the metaverse to shareholders, the stock would probably like double in a month. People aren't really trusting of the management right now, but the management has a really good track record. Mark Zuckerberg, I mean, he's done amazing things in the past. So I usually give people like that the benefit of the doubt. I mean, myself personally, I don't ever use Facebook. I don't use WhatsApp. I rarely use Instagram, so I don't have a lot of interaction with Facebook, but I know there's like 3 billion users. It's like super popular. Everyone uses it. I haven't looked too far into this, but this is just one that if you're looking for an opportunity to buy these big cap tech stocks, this is as good an opportunity as ever. So Facebook, number 4. At number 3, we have IAC, which if you watched the most recent video on my channel, this one is a recent purchase for the coffee can portfolio. It's actually the first purchase. So this is called the anti-conglomerate because they are sort of a conglomerate of a bunch of different businesses, but they spin them off and then they focus their attention on new businesses, and then they spin those off, and they just repeat this cycle over and over. And I'm going to go through this one kind of quick because I just went over it in the last video. Their market cap is 10 billion. But in the past few decades, they've created 100 billion worth of public companies that they've spun off. So it's a little deceptive if you just look at the IAC company. Companies that they've spun off in the past, their biggest, most successful one was Match.com, Tinder. It's called the Match Group. That's publicly traded. They have spun off Ticketmaster, Expedia, a couple other ones, Lending Tree. They've done a bunch, and their current roster of businesses is they have 2 really big reporting segments. There's Angie, which is Angie and Home Advisor, and a few other smaller like home service businesses that they're trying to like rebrand as Angie.com as the main brand. And that one is one that a lot of Wall Street people think might not succeed. It seems like they're having some trouble with it. People are starting to doubt their prospects with that one. Dotdash Meredith is print and digital publications. This is just like a really good cash flow business, like makes tons of money. It's easy to maintain. It seems like a pretty easy business to run. They have some pretty big brands, All Recipes, Better Homes and Garden, Investopedia is pretty big. The Spruce, very well, just lots of big brands. So that, and they just recently acquired Meredith. So this list of brands has grown significantly over the year. And then Search is a little bit, I would say it's a dying business, but they've made their money back and then some over the course of their time owning it. So it was formerly AskJeeves.com, and they've since sort of rebranded it to Ask.com, and it's not a great business. It's still one of their bigger reporting segments. I think it's their 3rd biggest. And then lastly, you got some lottery tickets in here. This is their emerging and other businesses, which are not big enough to have their own reporting segments yet. But a few in here that could become pretty big in the future. Care.com is probably the biggest one in this list, but then Blue Crew and Vivian are both like temporary staffing marketplaces that seem to be doing pretty well. So a lot of potential here. And IAC is currently trading at about 108 for the coffee can portfolio. I got it at 105. I'm going to continue monitoring it. I think we may get an opportunity to buy it even a little cheaper in the near future, but you never know. At number 2, we have a little bit of a new one. I've just started researching this one the past few days. It is called Nelnet. Kind of a boring business they're in, but they do have some excitement about them as well. So they have a lot of different lines of business there. They write really comprehensive shareholder letters, and you can see the alignment with shareholders is very evident. They have a long-term mindset. It's the type of company that I'd like to invest in because I know the people running the company, they really care about the long term, and they care about preserving my money, making it grow. Just really seems like a really good company. And they have, over time, as you can see from their chart, just grown consistently for years and years. So they do a lot of banking and financial services stuff. They also do a lot of work with student loans, and I have to do some more research to fully understand exactly what drives their revenue. They do software for like K through 12 education. They have a ton of different business lines. They do like payment processing, point of sale payments for different K through 12 education and stuff. They do some fiber cable. So it's like weird that all these businesses are together, but they do fiber networks to people's homes in the Southwest United States. They have some renewable energy services. They do some real estate stuff. And then a big part, which a lot of people are saying is maybe a little undervalued about the company, is their venture capital. So they have done a fair bit, I believe about $115 million in early stage investments over the last decade, which they talk about in this letter. They have a pretty big ownership share in this company called Huddle, which I've never heard of before. So I have to do a little bit more research on it, but it seems to be, this site is getting over 1 million page views per month. So, I mean, it's very popular. I just don't exactly know what it is, but yeah, it seems like the stake that they own in Huddle is very valuable. And when I do actual, like a full deep dive on it, I'll try to figure out what I think that the stake is worth. And I don't think they disclose exactly how much they own of Huddle either. And just the general vibe you get from the shareholder letter is they're very transparent. They're very cautious. Like, they have this whole Mike Dunlap's thoughts about economics. He goes through how he thinks, there might be some rocky roads ahead, and they're positioning themselves very cautiously to just make sure that they're around for the long term. And then number one for the month is going to be Prosus, which is a pretty popular, talked about value stock because it's gotten so cheap lately. Although it isn't a typical value stock in a sense that it is like a tech venture capital type of company. So a little bit of a confusing backstory on this one. Basically, there was a company called Naspers from South Africa that made a $30 million investment in a company called Tencent, which you may have heard of from China, which is now a $500+ billion company. My spreadsheet's a little messed up, but it's worth like 160 billion. They own about 30% of the company. I think 28.5% of Tencent. So Naspers became such a big company in South Africa. It was such a big percentage of the South African stock exchange that they spun off Prosus, and it's now listed in Amsterdam. And the idea is that it will unlock some value for shareholders because more people will be able to get into the company and get ownership of the company, because not many people trade on the Johannesburg Stock Exchange in South Africa. So Prosus has only been listed for a little over 2 years. It's nearing its all-time low, the March 2020 COVID low. Over the past year or so, it's been cut in half, and that is what's got me interested. The main thing you're buying when you buy Prosus is you're just really buying Tencent. Tencent is a Chinese company. It's mainly known for the WeChat app, which is big. It does payments, and it's a social app in China. They have a lot of video game stuff. They have Tencent Music. They have a lot of music rights and ownership and streaming services. Really diverse company. They also have a venture portfolio, so it's hard to like really quantify what everything's worth because Prosus has a venture portfolio, and then Tencent has a bunch of investments that Prosus then owns through Tencent. So they post this net asset value quarterly, I believe. This was last posted the end of December 2021. So a couple months ago, and you can see a lot of prices have dropped since then. So this is a little high, but they're saying their net asset value is 212 billion, and their current market cap is 111 billion. That's euro though. So probably like 90 billion US. So you're getting a huge discount to the net asset value, but it always trades at a discount. But here is what Prosus is comprised of. Mainly Tencent. You can see 162.3 billion of their asset value of the 212 billion is derived from Tencent. They own a bunch of other publicly traded companies that they backed when they were private, and they've since become public. So Delivery Hero, Trip.com, Remitly, a lot of like high-flying tech style companies. They're really big in the food delivery industry. They also have a lot of unlisted, currently private assets that are pretty big, more in the food delivery service. They also, they have some exposure to Russia. So it has one of their companies, which is Mail.ru, VK right here, formerly Mail.ru. That's essentially gone to like zero since this whole Russia-Ukraine thing started happening. The big thing with Prosus that you have to know is that China doesn't let foreigners buy shares of Chinese companies. So there's a workaround, which is called a VIE structure, variable interest entity, I believe. And basically, you can't directly own the shares of the company. So this is the workaround. You own the cash flows from the company. As China, the government has become like seemingly more authoritarian and communist, and like basically is exerting their force over the entrepreneurs in China. Like you can see with Jack Ma just like disappeared for 30 days. There's a lot of stuff going on that gives you some hesitancy to say, like, if the Chinese government says you don't own the company, then that's it. Your shares are just paper and it's worth nothing. That would probably be like the nuclear option. It doesn't seem likely that China would do that, but it is definitely a possibility. With any Chinese company, in my opinion, there's a chance that it goes to zero because the shares that you think you own could not really be shares. That's possible. And for that reason, the Chinese companies are trading at steep discounts, which a lot of people are saying this looks like value. I am a little nervous. And then since Russia invaded Ukraine, There's obviously the knock-on effects, which is like, what if China goes into Taiwan? Is this just kind of severing ties between the East and the West of the world, just geopolitics? So I think Prosus has taken a hit because of that as well. So there's a lot of factors. There's a lot of reasons why it's cheap. But it's kind of one of those scenarios maybe where Monish Pabrai, I think, is the one who says uncertainty and risk, they're not the same thing. So this seems like it's maybe an opportunity to buy the uncertainty and the risk, and there's maybe not a lot of risk there. I think there is some risk. That's the thing. But a lot of people will tell you there's uncertainty, there's maybe not a lot of risk. So it seems to be, obviously, if this was a company that was traded, like if this was a US company, this would be easily a $150 company, 150 euro. But it's not. There's some risks associated with it. So I'm definitely keeping my eye on it. At a certain point, the risk reward is just heavily in your favor, and I think we're probably getting close to that point. So that's going to do it. Those are the 5 picks for March. Comment down below. Let me know what you think. What are your picks for March? Or do you have any companies that you're looking at or you want me to look into? Let me know. Comment down below, and thanks for watching.